Okay, this is problem 55A. It's located in your text on page 232. The first thing I would do is see what's required. They want me to prepare an income statement through gross profit for the year ended December 31st, 2008. So in order to do this, they would have to give me the sales and they would have to give me the cost of goods sold, or at least give me the information so I can calculate those items. When I look at the problem, they give me freight in, merchandise inventory, purchases, etc. So they give me the information there, and that is the adjusted trial balance. They give me some additional facts. In number one, they tell me the merchandise inventory on December 31st, 2008 is 75,000. I'm reading right out of the text. And then in number two, they're telling me that this department store uses a periodic system. So a periodic system means that I don't know, I don't keep track of my cost of goods sold during the course of the year. I'm going to take a physical inventory count at the end of the year and then calculate my cost of goods from that. But they should give me the information for all my purchases, any type of discounts, any returns and allowances, and that's what they do. All right, so the first step would be to calculate the purchases from the information provided. So I'm going to put in my amounts here, and if you look, because this is a periodic system, these items, purchases, purchase discounts, purchase returns, and my freight in, they are all separate accounts located on my income statement. If we were under the perpetual method, these items would just be included in your inventory account. Remember how I was doing it with the popsicle sticks, right? I had my 2 cups, and we were just keeping track of the inventory. Every time I purchased something, it went right into the inventory account. That's not the case with periodic. Periodic, you're just going to expense your purchases. You'll record on your income statement your purchase discounts, your purchase returns, and your freight in. All right, I'm going to stop talking. Let's just look at the problem, and they give us the purchases of 447,000. So I'll put that in there. I want to subtract out my purchase discounts. They tell me that amount, that's 12,000. So I'll use a minus 12,000. Purchase returns. They tell me that's 6,400. So again, I'll subtract that out. And recall, if we were using the perpetual method, I would be crediting my inventory account for the purchase returns. I would be crediting my inventory account for the purchase discounts, and I would be debiting my inventory account for the purchases. Okay, remember that. Also, freight in, I would be debiting my inventory account for any freight that I paid in order to get that inventory to my store. And they tell me that's 5,600. So I'll add that to my amount. Now, I'm in the cell for total cost of purchases, and what I'll do is just use the summation sign right up here on the toolbar, and that'll sum everything right above it. So my total cost of purchases comes out to 434,200. Remember, this is the periodic method, and so on my income statement, I have all these items listed separately. All right, so now with that, I can calculate my cost of goods sold. All right, they have to give me, remember our calculation, cost of goods sold. You're going to take your beginning inventory. I'm going to add any purchases to it. I'll subtract out any ending inventory, and I'll come up with my cost of goods sold. Notice too that when you add your beginning inventory and your purchases together, that gives you your total inventory available for sale. So that's everything for the course of the year that I was able to sell. That's everything in my inventory. So I'm going to take my beginning inventory, and they give that to me in the problem. Merchandise inventory is 40,500. So I'll put that there, 40,500. Then what I want to do is add to that my purchases. I can just use a formula. I could link it. I'll use the equal sign, and then I'll just go right up and take that number, the 434,200 that we calculated from step one. That was our purchases from the information that they provided to us. All right, so now my total inventory available for sale would be the addition of those two numbers. So I'll do a formula. I'll use the equal sign. I'll use the arrow key to go up to the 40,500, and then I'll do the plus sign. And then again, I'll just arrow up to the purchases here, and I'll hit the enter key. So there's the total inventory available for sale, 474,700. Okay, now I want to subtract out the ending inventory. So obviously they must have performed a physical inventory. They counted up their inventory, and at December 31st, 2008, it came out to 75,000 of goods that they still had on hand at the end of the year. So I want to subtract that out. Once I subtract that out, that's what I didn't sell. So I'll subtract out the 75,000. And then if I just take the addition of those two, right? In essence, I'm taking everything I had available for sale, whatever I had left over, I'll subtract from that, and then this will give me my cost of goods sold. Okay, 399,700. Okay, so now let's continue. Now I have the information to prepare my income statement. I have to take the sales, the amount that they give me, and again, they have to provide this to you in the problem. They tell me sales are 718,000. 718,000. Okay, then I want to subtract out my sales returns and allowances. And on an income statement, you're not really going to show negatives. So here I'll put my sales returns and allowances as 8,000. And then what I'll do, my net sales will be the net between the two. I'm going to take my gross sales and subtract out my sales returns and allowances. I didn't have any sales discounts. Otherwise, I would include another line item there and subtract that from my sales. Notice the sales returns and allowances is considered a contra revenue account. It has a credit balance. It has a debit balance because your sales has your credit balance. So a contra revenue account will be the reverse of that. A revenue account normally has a credit balance. A contra revenue account will have a debit balance. So I subtract the two and I get my net sales of 710,000. Then I'm going to put in my cost of goods sold. Now I can just take the amount that I calculated in step 2 of 399,700, or I can link it. I can use Excel to do a formula. So if I use the equal sign, that's letting Excel know that I'm going to use a formula. And then I can just arrow up to that 399,700. Notice in my cell that I'm putting this formula in, it's referencing D16. That's exactly where my cost of goods sold number is. Column D and row 16, right? That's the cell range. So here I'm going to just hit the enter key and it'll return that amount. 399,700 was my cost of goods. So now I'm just going to subtract the two. So again, I'll put a formula. I'll use equal. I'll arrow up to 710,000. I'll use the subtraction key. And then I'll just subtract the 399,700, hit enter, and there's my gross profit. So we prepared the income statement through the gross profit figure, and it's complete. We completed the problem. All right, that was problem 5-5A on page 232 of your text.